Hey everybody, hey traders, Chris Pulver here. Welcome back to the Pulver Report, where we trade to be profitable, not perfect. It is nearly 2022. I can't believe how fast this year went, but the big question on my mind, and hopefully your mind, is where are the markets going? Will the markets keep falling? Will they find their footing? How can we position ourselves for success with a brand new trading year with so much at stake? So all that and more, let's dive into those bullish and bearish catalysts today on the Pulver Report. So if you're out there searching for 2022 stock market forecast, here's what you might find. Fortune.com reviewed published models by Bank of America, Goldman Sachs, JP Morgan, and even Morgan Stanley, 4 major influences out there in the investment banking world. And what's the big takeaway? There really isn't one. They're not all in agreement. They're all over the place. So the forecasts are on a spectrum. Another bullish year. Another maybe above average year. A correction is likely. Sideways movement, range bound is likely. Negative, break even, positive. It's all over the place. So of the big players mentioned, Goldman Sachs and JP Morgan are actually the most bullish. Goldman Sachs is predicting that the S&P 500 is going to break 5,000. That's a major milestone and climb by about 12% for the year. JP Morgan, also on the bullish spectrum, is echoing that 5,000 point break. And no, that's not the Patrick Swayze, Keanu Reeves type of break. It is a 10.6% gain for 2022. And even with a bullish outlook, headwinds are acknowledged. You have some potential hurdles: decelerating economic growth, you have Fed tapering, you have Fed tightening cycle, rising real yields, and persistent inflation and supply chain concerns. And speaking of inflation, let's take a look at this chart showing the average annual returns at different inflation rates from 1970 to 2021. That's a 40 plus year period. And with the rolling 12-month inflation rate at or less than 0% or above 6%, annual returns are negative. And as we wrap up Q4, the US inflation rate is expected to be 7%. Now, although the Fed said that inflation was transitory, until of course they changed that, inflation is a real sticking point on economic growth. It's not a good thing. Now, what I like, and I'm taking away from this chart, is it's impressive to see that even with 4 to 6% inflation, we still saw positive returns in the US equities and US fixed income markets. Now, rather than being super scared about inflation, the Fed just needs to get a hold of it, needs to dial it back anywhere between 2 and 6%. And then for the last 40 years, it's showing us that annual returns are going to be okay. So we have some bullishness. We're acknowledging inflation. What about a break-even or a bearish projection? Now, Bank of America is publishing a lackluster return for the S&P, looking at less than 1% gain. If that's what it is, you're going to lose to inflation for that year as an investor. Now, Bank of America is also looking at small cap stocks versus large cap, because they're citing that they traded better and performed better during most of the pandemic. So again, spectrum-wise, we have Goldman Sachs and JP Morgan on the bullish side, we have a neutral Bank of America, and we have a negative Morgan Stanley, looking at like 2 to 3% to the downside. Who's right? Again, they're all conservative projections. I think we're facing a very delicate environment going into next year. So what I'd like to do now is build a list of catalysts, both for the bulls and for the bears. So let's start with the bullish catalysts. Stimulus is not over yet. It's going to take time to taper. Interest rates will be very slow to rise. The Fed will still be willing to modify. They will still be accommodative. You can see that in their narratives even right now. The next few go hand in hand. Bigger, faster, stronger companies, tech and innovation, and strong fundamental companies will remain attractive and most likely outperform the overall markets. Historically speaking, there is a built-in bullish bias. If we've had any sideways movement, if we've had any downturns, the bounce back post dips, corrections, bottoms have been really, really strong. And finally, if you're still a trader and you're still an investor, you're going to put working capital to use. And right now, there's no better place to do that than in the stock market. And now let's jump to the other end of the spectrum with bearish catalysts. Number 1, stimulus is ending. We know it's coming. The taper tantrum is likely a reality. Interest rates will rise and stunt growth and expansion. In 2022, it's forecasted the Fed will raise rates 3 times. They're not the only central bank around the world. There are tons of other banks that are looking at the Fed to start raising rates. Inflation is here, inflation is real, and inflation, if it's persistent and potentially higher, it's going to cause some problems. Supply chain issues will also continue. COVID and additional variants like Delta, Omicron, and future mutations, they're not going away. Too much concentration in too few stocks. It's more like the S&P 5 versus the S&P 500. If you want to learn more about that, watch my $100K to $1 million portfolio when I talk about the FANG stocks. In most of November and December, what we saw in the stock market was a deleveraging and an unraveling of risk. If we see lower volatility in the stock market, that's going to make traders bored. Now, it's not a bad thing. It's just going to be stunting growth and expectations. And as a chart enthusiast, this is a big one to me. Technical corrections are needed. I've talked a lot about these in my live sessions. Engineering gains and getting out of these crises is not sustainable. We know that this has to end badly. We know that the markets have to face some type of reality. We might see dividends come back in a big way and value come back in a big way. Again, if low volatility persists, value, dividends, probably the best way to trade in 2022. So we have team bulls, we have team bears, we have team I don't know. If you have something you want me to add as a catalyst, add it to the list, leave me a comment for today's video. The major investment banks I mentioned, they're all forecasting a different spectrum of directions. Fairly moderate movements. They're all pretty conservative, slightly bearish, neutral to bullish. These are all very safe forecasts and probably safe and accurate. Now on the fringe, we have these growing factions of skeptics and cynics who feel that the entire system is on the brink of collapse. And it's the canary in the coal mine and all of it's going to end. And on the other end, you have these permabulls who will just keep buying dips forever. So somewhere between bearish, bullish, and everywhere in between, we all fall in that spectrum. So regardless of what happens, we have to give ourselves working capital, some time, some patience, and stay open-minded. Be objective and be cautious. Be nimble, be agile. I keep saying those words, but it's super important that we can trade to be profitable. And so if I go back to the charts for a second, the S&P 500 at 5,000 is a major milestone, and I would love to see it. But hopefully 5,000 comes after a much needed technical correction, because the more and more overstretched we get, the more bearish I'm going to be. So I wouldn't mind seeing a sideways move before we end up building that base and then ascending to 5,000 plus in the S&P. Now, I'll look back at the charts and let's use an example. 2015 and 2016 on the S&P 500. And this all stemmed from the 2008-2009 financial crisis and the 2009 low that was put in March. Now, what you can see after that is persistent higher highs and higher lows. And the market seemed to stretch in that expansion cycle and then cap out in 2015. And so although it was a post-recession run, a post-bottom run, when we struggled, we saw these peaks and valleys between 12.5% to 15%. And it took over a year to break those range highs. And then once we broke in 2016, we had another expansion cycle until we peaked and capped in 2018. 2018, 2019, we started to see this broadening formation. And then we had a crisis bottom in 2020 with COVID. Now that was the fastest bear market to bull market recovery that I have ever seen, and percentage-wise and points-wise that we've ever had in the stock market. And after the low was put in with that COVID bottom in March 2020, look at where we are now. We have certainly stretched a long, long ways. Now, can we justify these highs? Maybe. I don't think so. Technically, there are corrections that are long overdue. So, this is why I think the market catches its breath. This is why I think that we base here. This is why I think we have a 10, 12, 15% range that is going to happen. Now, if we can justify these valuations, we can justify where we're at, then we can go higher. Or we have to correct first, fine. But I think the longer we stretch and we kick the can down the road with a correction, the more bearish I become, all right? So that's what makes 2022 very interesting. And if we start to break these highs in the S&P, I think the S&P can make that run to 5,000. I think the Dow Jones can follow and also make a run at 40,000. But as I've literally been saying for most of 2021, I am cautiously bullish. I'm picking my battles carefully. I like having cash at the ready. I like feeling 100% comfortable, 100% committed to owning the stocks that I have right now for 3, for 5, for 10 years and continue to be patient and building positions. Now, if I'm speculative, I'm looking for faster profits, I want to lower my costs as quickly as possible and take those chunks of profit. 5%, 10%, those are great. 20, 30, those are awesome. Some spec plays, some SPAC plays, fast profits, nobody's going to complain. But for the big portfolio and long term, I'm willing to build and hold and keep adding. So 2022 is going to be a great year to know how to trade. Weather the storm, buy low, maybe accumulate at some bases, find great stocks, trade great stocks. Thanks for watching today's video, and be sure to tune in next week for the Pulver Report, where we dive into the 2022 forecast with cryptos and Forex. Until next time, happy trading and lots of profits.